It's funny time, Roger. Stocks at all-time highs, but we've got the 10-year yield sort of softening. Oil's coming down. I'm curious. You spend a lot of time in boardrooms talking to CEOs. Confidence is always important. What are you hearing out there?
Well, I think the economic outlook here in the United States remains solid. But it's a split screen outlook in the sense that the consumer side of the economy, remember that's 2/3 of GDP, that's the bulk of it, is strong. Household net worth is way up. I mean, the figures actually are amazing on that, driven by housing values, which were very up strongly in 2019, and of course by the stock market. Consumer net worth is way up, and consumer confidence levels are right around all-time highs. So that side of the economy just is strong. The business investment side is weak. CapEx trends are weak. Business confidence is weak. You see that in things like rail car loadings and rig count. And so we're in a mini recession from a manufacturing point of view. And that's why some of the factors you mentioned, like WTI and like the 10-year yield, are down. But I think the economic outlook remains pretty solid, and we're probably going to have a 2.25% year, something like that, on real growth in the United States. And some of that is driven by, or a little bit of it is driven by a synchronized global recovery, like the new head of the IMF referred to in Davos a couple of days ago. And that in turn reflects this strong continued monetary easing around the world. It's just relentless, and that always operates with a lag. So the economic fundamentals, with the exception of manufacturing, are good.
Yeah. When you speak of a lag, we're going to get USMCA signed momentarily, I think. And obviously, we got that trade deal that you've been promising. It took a while, longer than you'd expected, but we got it with China. Is there going to be a lag? Are we going to see the effects of that this year?
Well, I think the effects of those are really to lower the trade tension factor. I mean, when we were sitting here 3 months ago, 6 months ago, 9 months ago, we were talking a lot about the impact of trade tensions, especially U.S.-China, on confidence, on market levels, and so forth. Right now, the trade tension index, if there was such a thing, would be well down, and I think that itself is a positive. Exactly the impact of the trade deals themselves, I mean, we've all seen the forecasts on growth factors. The China deal, pretty modest factor on growth, maybe 1 or 2 tenths of a point, and also on a lag basis. So I think the biggest impact of these agreements is on trade tensions and lowering them, and therefore improving generally confidence. And we see the market, despite the virus issues, at an all-time high.
Richard Fisher's out today, says that the repo operations are a derivative of QE. Kudlow said it this week. Kaplan said it. It's going to be one of the first questions Powell gets next week. So if he tries to disabuse the market of the notion that it's going to be around forever, what happens?
Well, I think we are going to see QE in various forms. If you think of the Fed balance sheet itself, for example, as a key measure of that, I mean, the Fed balance sheet is growing again. And is that going to change over the short term, Carl? I don't think so. Some people define QE one way, some people define it another way. But if you just think of growth in the Fed balance sheet as a measure of that, I think we're in another period of that growing, which is...
For years?
I don't know the answer to that. But it wouldn't surprise me if we're a very long way from what you would call a long-term reduction in the Fed balance sheet. So I don't think this is going to be anywhere near as aggressive as obviously we saw a few years ago when we were trying to come out of that deep hole. But I think if the Fed balance sheet is growing, and it's probably a long time before it's going to start to be reduced.
The market's obviously very comfortable with whatever's going on. Financial stress measures are at pretty much record lows. So that side of things looks fine. But with regard to this sort of confidence comeback or not, this generation of CEOs seems like they take any excuse to become cautious. So is the election going to be the next thing to say, you know what, maybe we have to wait around before we make any bigger decisions? Or do you see it coming back before that?
Well, I don't know if it's an excuse. I mean, the election is a big uncertainty, whatever your mindset a year ago was. I mean, it just is. Because you can see stark differences between the two sides, and the implications for policy if one side wins the presidency and holds the Congress versus the other side. So I think it's an authentic uncertainty, and it's perfectly legitimate for people to say, I'm going to wait and see what happens here before I'm aggressive. I think that's historically the case generally, although this election's probably a little greater uncertainty than many. Probably going to be quite a close election, among other things. So that's a legitimate thing. I don't think it's really CEOs looking for an excuse. I think it's really a big uncertainty.
Yeah.